Hey there, everyone. Dave Keller here with Market Misbehavior. The volatility remains fairly low as measured by the VIX. However, I would say the emotional volatility for investors probably as elevated as ever. We've had a lot of noise in the markets here over the last 4 weeks or so. From mid-December to mid-January, we've broken briefly below our line in the sand of S&P 5850, and then just as quickly reverting back to the upside, threatening and pushing briefly above 6,000 through the end of this last week. What comes next as you look forward through the rest of January and into the end of February at the beginning of March? Over the next 6 weeks, do we see a resumption of that strong uptrend phase that we experienced toward the end of last year? Does the S&P regain its mojo? Does growth leadership re-exert itself to the upside and the S&P sees 6,200, 6,300, even 6,400 by the end of February? Or does the S&P regain its downward mojo? Is that initial sell-off that we saw into mid-January just the beginning? And after this counter-trend bounce that we saw last week, we continue lower. The Fed meeting maybe not as optimistic as we would expect. And as a result, stocks continue their downward slide with the S&P threatening its 200-day moving average going to the end of February. In today's exercise, a choose your own style video. This is one that we've featured a number of times on the channel. It's become pretty popular, and the idea is to think about different potential scenarios in what we call probabilistic analysis. The goal here is threefold. Number one, think about 4 different potential scenarios. Open your mind to the fact that the market can do a lot of different things over the next 6 weeks. And just think about what the possibilities are. Really embrace those different scenarios and think about what those conditions might look like. Number two, think about which you see as most likely and really think about your investment thesis and what that potential scenario would actually look like if it played out. What would that mean for your portfolio and opportunities over the next 6 weeks? Finally, cast your vote. Put a comment below with which one you see as the most likely and why. But don't forget to check out other people's votes and comments as well, because if the point of this is to stretch your thinking, if you're bullish, check out some bearish comments and think about what is fueling their analysis. If you're bearish, think about the investors voting that are all bulled up. Think about what is causing them to be so optimistic when you are everything but. At the end of this video, I hope you take a time to vote and cast your vote on which scenario you see as most likely and why. Before we get to those 4 scenarios and their potential implications, here's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions. And when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koyfin. Koyfin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koyfin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koyfin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. All right, so before we get to the forward-looking scenarios, let's talk about the last time we did this, which was actually a really interesting time. It was toward the end of October. And just before Halloween, the S&P had just broken above 5850. And the question is, will it make the push to 6,000? We laid out 4 different scenarios, and I'd encourage you to click on the link in the description, go back to that video, and see what different scenarios we talked about and how that related to what actually played out. But if you look at the chart, here's what happened. For the first week or so, it looked like scenario 4 was an absolute banger, a spot-on pick, because we immediately sold off in the days following that video was released, going into October, which ended up being essentially the low for that little stretch. So scenario 4 started out, but then we immediately gapped higher, went above the trajectory even we expected for the most bullish scenario. Look at what happened from late October to early December. Over that 6-week period, we almost perfectly to the mark hit that number one scenario. So if you voted scenario number one, the super bullish scenario, congratulations, you had it right. However, again, the goal of this exercise isn't to be right necessarily, although that doesn't hurt. The point of this is to think about different scenarios, to force yourself to step away from what you are pretty sure is going to happen and think about the possibilities of what could happen. And again, that's the point of probabilistic analysis, is to stretch our thinking a little bit. So I hope you can use that as inspiration to think about the next potential steps here for the S&P 500. We've laid out 4 different scenarios starting to where we're at here at the end of the week on Friday, January 17th. Now, the S&P is almost exactly at 6,000. At the close, it's around 59.97. So while the S&P did get up to 6,100 about a month ago in early December and did get briefly below 5,800 earlier this week, that was on Monday's session. By the close, we're back toward the upper end of this range that we've been in for the last 10 weeks or so, right around 6,000. Here are the 4 different scenarios. And again, I'd encourage you to think about all 4 of these. Think about what they might mean. Think about what that might look like, how that might impact your portfolio. Start to think about which one you see as most likely. And don't forget to put a comment below and let me know which one you see as the most likely scenario and why. The super bullish scenario, you always have to have an optimistic scenario, just like we always need to have a pessimistic scenario. I think the goal here is to think about sort of extremes and then think about some of the middle ones as well. What's interesting, again, as a reminder, is the last time we did this at the end of October, the super bullish scenario ended up playing out almost perfectly. So keep that in mind here. But with the S&P's bounce back up to 6,000, that has a lot of investors thinking maybe this pullback in December into early January was just a brief pullback within a long-term uptrend. So what I basically did was took this trend from August, September, October, November, just kind of took a parallel line and just kind of kept that going. And that leads me to right around S&P 64 to 6,500. About 6 weeks from now. That would be about an 8 to 10% rally, would say. I guess depends on how quickly we get up there, what sort of movement it is, but think about 8% above current levels here as of the close this week. So if we would resume the uptrend that we experienced through much of September, October, and November, that would get us that upside target to 6,500. Well, now that we are through that sort of initial economic data, the inflation data from earlier this week, now that earnings season has kicked off and overall starting pretty strong, I would say, in terms of the initial results from financials through the course of this week, I would say the next couple weeks would have to be incredibly strong earnings. Things like the strong dollar would have a minimal impact on mega cap growth stocks. This would really need to see semiconductors break out. Semiconductors right now are sideways. The SMH is still in a consolidation pattern that would have to break out. I would say Nvidia has to make a new all-time high. Other Magnificent Seven names like Meta, Amazon, Alphabet have to improve. Stocks like Apple can't go down anymore. They have to really start to find their footing and push back to the upside. So you would need to see significant leadership from the Magnificent Seven stocks. And I would say if the S&P is going to get all the way to 6,500, that would mean mega cap growth. Those big companies with big weights in the indexes would have to really resume their uptrend. So if you think that's the likely scenario, if you think the Fed is sort of a non-factor at the end of this month and going into the beginning of March, we're talking about a very optimistic scenario and how, remember that bear market we all started talking about in early, December and January? What happened to that? That's the super bullish scenario number 1. S&P ends the month of February around 64 to 6,500 in that scenario. Scenario 2, the mildly bullish scenario. Let's say maybe this pullback is done and maybe this is the low here in early January from Monday, but we continue the rally, but it's not as strong. Maybe the Magnificent Seven stocks are not the leadership. Maybe it's more value-oriented sectors like financials and industrials and healthcare. And don't look now, that's really what we've seen so far in the month of January. It's not been mega cap growth really leading the way. It's been some value sectors that are starting to improve on a relative basis. So those themes that we've started to observe here in the last couple of weeks would need to continue, because for the S&P to go a little bit higher, that would mean the Magnificent Seven stocks are either remaining range-bound or just not really leading, and maybe other things are leading and other things have much better returns, but the benchmarks weighted so much to those growth stocks just don't see a lot of potential upside. I would say this mildly bullish scenario probably takes us back to the previous high, maybe briefly above 6,100. So maybe you end the month of February around 61 to 6,200. But again, the downdraft that we experienced in December and January is pretty much in the rearview mirror, and it feels more optimistic. It's more about leadership rotation and less about any sort of defensive rotation. That's scenario number 2. Scenario number 3 would be the mildly bearish scenario. So this is where we definitely don't regain 6,100. So maybe we trade a little bit higher next week, but we're not able to get above that previous high. And to the contrary, we actually continue the downside rotation. However, there's enough action in some of those defensive sectors like utilities and real estate, in some of the value sectors like maybe energy and industrials, to hold the benchmarks from losing too much of their steam here over the next 6 weeks. Maybe this mildly bearish scenario 3, takes us back to around 57 to 5,800. We're retesting the January low, and all of a sudden it feels like the uptrend has stalled out. This rally that we saw this week was clearly a counter trend rally, and now we're resuming the downtrend of lower highs and lower lows, and then we're debating whether that January low will hold. Maybe we briefly undercut that, and we look at things like RSI to see if there's any sort of bullish divergences. But I would say the mildly bearish scenario maybe means the Fed meeting at the end of January is a lot less optimistic than we would expect. Maybe the prospect of future rate cuts are taken off the table in some way. And investors all of a sudden get nervous yet again that the Fed is out of bullets, that the conditions are not as ideal as we were sort of the market was pricing in the September, October, November timeframe, and we continue this pullback. We're left in a similar situation that we were at the end of last year, which is we're not making new highs. We're not really making new lows too much. Where do we go from here? So it's sort of a neutral, slightly bearish scenario. Scenario number 3 would probably end up around 57 to 5,800. You always have to have a bearish scenario, and scenario number 4 is what we call the super bearish scenario. In this way, in this particular scenario, the rally that we experienced last week is short-lived. We immediately resume the downtrend. I would say charts like semiconductors, the SMH, break down and actually break below support. Apple continues to lead lower than the rest of the Magnificent Seven. All sort of join Apple in a period of deterioration. Charts like Tesla, which have had nice rebounds, start to fail and start to give back some of those recent gains. Defensive sectors probably improve on a relative basis, although most everything is probably losing value in that scenario number 4, but you really see improvement in the relative performance of defensive sectors like utilities, consumer staples, and real estate. And to be clear, we've not seen any of that sort of improvement in the relative strength of defensive sectors. So this would be a very new sort of look and feel. It would change from a clearly bullish environment in the third and fourth quarter of last year to more of a sideways environment in January, to now more of a distribution environment going into the beginning of March. I would say part of that super bearish scenario is we undercut the 200-day moving average. That's currently sitting right around 5,600, but you figure it will slightly tick higher through the course of the next 6 weeks or so. So, we undercut the 200-day and we get down maybe to around 5,500. That'd be about an 8% drop, which is not the end of the world. I mean, there have been much worse sell-offs in market history for sure, but it certainly makes investors a lot less optimistic, a lot more nervous. And as we progress through earnings season, maybe it's a lot more disappointing than we would expect. Maybe the stronger dollar really weighs on those mega cap growth names, and that causes the next leg lower. But by the end of February, we are really starting to look back at previous lows. We're using Fibonacci retracements to identify some potential downside targets. We're pretty concerned about further downside objectives from there. Those are your 4 scenarios. As a quick recap, we have the super bullish scenario, probably putting the S&P to around 64 to 6,500 over the next 6 weeks. This would, clearly break the December high, move the S&P to new all-time highs with the resumption of the great uptrend of 2024. Scenario 2. The mildly bullish scenario, we drift higher. We sort of maybe break above that December high around 6,100. We don't make a lot of progress beyond that. A lot of the issues that have plagued this market are still there. Maybe the Fed meeting still leaves a lot of question marks as opposed to answers. And we drift higher, but it's not a significant breakout. Scenario 3, the mildly bearish scenario, we retest those January lows around 5,800. Maybe we hold them, maybe we go slightly below, but generally we're at the lower end of this range. It doesn't feel like the market's going up anymore, and some of those stocks that have bounced so much here in the last week all give back those gains and maybe a little bit more. Scenario 4, the very bearish scenario, would be a break of the 200-day moving average, the S&P leading down another 8% or so to around S&P 5,500, maybe a little lower, around 5,400. We talk about this week as being a huge counter-trend dead cat bounce as the downtrend resumes in earnest. The Fed meeting leaves a lot of concern and basically reinforces the fact that the Fed is completely behind the eight ball and unable to stop speculative forces from pushing prices lower. Which of those scenarios do you see as most likely and why? Make sure you drop a comment below and let me know your vote and your reasonings. Don't forget to check out the other comments. It's a lot of fun to see what all of us, with a lot of different toolkits and different biases and different ideas, are all sharing what we think. By the way, if this sort of thinking about technical indicators, about the relationship between macro themes and the charts, about having an actionable toolkit to identify buy and sell signals with stocks and ETFs that you're trading, if those are of interest to you, I hope you will check out our Market Misbehavior Premium memberships. If you really want to upgrade your decision making, improve your understanding of the technical analysis toolkit, our Market Misbehavior Premium memberships can be a great way to do that for you in your own process. 3 key parts to it. Number 1, our virtual courses covering technical analysis and a lot of other tools. Number 2, our members-only reports, things like our weekly flight plan, which we put out every weekend as a main way of evaluating market conditions and looking forward. Also, our monthly chart review. Finally, a members-only community, which you would have access to, the ability to ask questions of me, some of the other premium members that have been with me for quite some time, sharing ideas, sharing frustrations, and getting answers to all of those questions at the top of your mind. Go to marketmisbehavior.com/premium for more info. Make sure you use the code YouTube when you check out for 20% off your first 12 months on any plan. That's it for today. For Market Misbehavior, I'm Dave Keller. Have a great one. And remember, it's always a good time to own good charts.